Have you ever wondered about the hidden safeguards that keep our financial system stable and secure? It is easy to take for granted the trust we place in banks, but behind the scenes, there is a complex history of regulation designed to protect depositors and prevent crises. To directly answer the question, while the Federal Reserve Act of 1913 significantly transformed American banking, it did not establish bank examination. Instead, it refined and expanded existing examination practices that had been in place for decades, primarily under the office of the Comptroller of the Currency. The Act empowered the newly created Federal Reserve System to conduct its own examinations of member banks and to coordinate with other regulators, aiming for a more cohesive and robust oversight framework. Before the Federal Reserve Act, national banks were already subject to examinations by the Comptroller of the Currency, an office created during the Civil War to supervise the national banking system. State-chartered banks, on the other hand, were examined by state authorities, leading to a patchwork system with varying standards. The Federal Reserve Act addressed this fragmentation by giving the Federal Reserve Board broad supervisory powers over its member banks, including the authority to examine them. This was crucial because it introduced a more centralized, comprehensive, and standardized approach to supervision across a significant portion of the banking sector. The goal was to prevent bank failures, ensure sound banking practices, and ultimately foster confidence in the financial system after a series of panics that plagued the country. The Act enabled the Federal Reserve to oversee a bank's financial condition, its compliance with banking laws, and the quality of its assets, moving beyond just solvency checks to a more proactive assessment of risk. So, what did this mean in practice for banks? It meant that national banks, already accustomed to federal scrutiny, now faced an additional layer of oversight from the Federal Reserve, often in conjunction with the Comptroller. State-chartered banks that chose to become members of the Federal Reserve System also became subject to these federal examinations. This new collaborative examination regime ensured that regulatory efforts were more coordinated and effective, reducing duplication while enhancing overall systemic stability. It laid the groundwork for the integrated regulatory structure we recognize today. An interesting insider detail is the concept of lender of last resort. While bank examination focused on preventing problems, the Federal Reserve also gained the power to lend emergency funds to solvent banks facing temporary liquidity issues. This interconnected role of examination and lending was a game changer. The Federal Reserve's examinations provided the necessary information to determine a bank's solvency, thus informing decisions about whether it was appropriate to extend such critical lifeline credit. This dual mandate of supervision and liquidity provision helped to mitigate the severity of financial panics. The Federal Reserve Act truly transformed American banking by integrating and strengthening supervisory efforts, even if it did not invent bank examinations. It shifted the regulatory landscape from a fragmented system to one with increased federal coordination and authority, particularly through the Federal Reserve's ability to examine its member banks. This enhanced oversight, coupled with its role as a lender of last resort, became a cornerstone of financial stability, helping to prevent the rapid spread of fear and collapse that had characterized earlier banking crises. Understanding this evolution reveals how critical continuous, robust supervision is to a resilient financial system.